It's a lovely Friday, beautiful traders. How you guys doing? I am doing absolutely lovely. And we're about to close off the week. One of the most relaxed weeks, in trading history. You know that if we don't have a setup, we do not have a trade. We only had 2 trades in our accounts for this particular week. The opening on Monday, I did have 3 trades because I already had a US30 trade running from last week that I held through to Monday, as you can see right over here, which opened with a nice, beautiful gap. You saw that in the previous video, but in the inner circle, we only had a trade on the NASDAQ on Monday. On Tuesday, we added positions to that trade. Wednesday, we did not have a good setup. Thursday is a holiday, and today, Friday, is also a holiday. You know that we always want to trade when the market has enough volatility for us to be able to capitalize on each of, the movements, each of the candlesticks that we have, right? We don't want to just go into a trade right now and the market barely moves and we end up having to close our trades. It might move in loss. Imagine it just starts going down against us and we have to hold that loss over the weekend, and you never know how Monday will end up opening, right? So one of those relaxed weeks in our group, I'll just be disciplined, take this time to backtest a lot of things, right? So you know that today we're supposed to drop a lit video, and I was just thinking about, why is it so hard to get a good stop loss? The market always hits your stop loss and then moves in the direction that you would have anticipated or that you would have analyzed. I know a lot of people like to blame the market, it's manipulated and all of those things. It's understandable when you are starting to trade, when you're a beginner trader. But if you have enough experience, intermediate traders, you know that there is nothing in Forex trading that you can ever blame on the market. It's solely all on you, right? Now, the question here is, why are you always stopped out too soon? So today I will just talk you through the best, maybe call it stop loss strategy that you might want to use or put into your trading plan when you're trading to actually check out for this thing so that you can avoid all of those early stop outs. Now, if you've noticed, when I trade, most of the times I barely put a stop loss, right? This is because I'm always actively monitoring my trades, right? When I'm trading, right? You always see me, I'm always on the charts checking after every candlestick for whatever time frame I will be trading. And then if it breaks below a level that I want as my stop loss and closes outside of that, then I'll eventually leave the trade, right? But then if it weaks out, I normally don't leave the trade. So those of you that have been watching most of my videos, you understand that exactly how I trade with stop loss. Now, it's not everyone that has that, luxury of actually being able to check their trades every second, every time, every candlestick that they can look at, just checking it, right? Some people have other commitments. You have work where you can barely look at your phone. Now, a stop loss is simply an order that you place in the market that when the price gets to that place, you are taken out of the trade. And one of the most important things when you're trading is a stop loss. I know it hurts when the market hits a stop loss, but it's absolutely important. It is needed to protect your capital so that you're able to then take the next trade. But then the thing about these stop losses is, how is it that the market knows the exact place where you are always placing your stop loss such that it always hits your stop loss? Haven't you asked yourself that thing? How is it that it always knows? Why are you always liquidated? Why does it know that specific point? How come they know that if you're buying at a certain rejection or at a certain breakout, you're going to place your stop loss at the certain level? How is it that the market always knows that particular thing? That's now the burning question that you should always ask yourself. Now, the very simple reason here, I'm not even going to tell you anything out of the ordinary. It's just simply because you yourself, you don't even know why you're placing your stop loss at that spot. Now, if you know why you are placing a stop loss at a certain level, then there's a high chance that that stop loss is not going to get hit, right? There is a high chance. That does not mean it's not going to get hit at all. It's just a high chance. When I was learning how to trade, I did read that Market Wizard's book, right? And there's a quotation in there that says a stop loss should be placed at a spot that if the market gets to that level, it means that the analysis that you've made is absolutely wrong. Right? I'm always saying this in most of my videos and people don't seem to get that point. Now, if I analyze using, let's say, a trend line analysis, let's give a scenario right over here. I am trending to the upside on the NASDAQ, right? I have a little trend line, 3 touches. During the New York session, it gets to a specific zone. That is my point of interest on the trend line. I expect the market to reject at that level. It does reject. I have a good entry point, I enter the market. And then a lot of people like to place their stop loss right below the trend line, forgetting all the other levels on the left side that the market might want to come and retest. So what the market normally does, it wicks out, goes and takes out all of those positions and then ends up moving up to the upside, right? So the simple thing that you have to do here is to consider all the positions that the market can tap on before moving in your direction, and you want your stop loss to include and accommodate all of these positions. So if the market comes and tries to wick out these other levels, right, and then eventually moves in your direction, it's not wrong. The market doesn't move to the upside with one single, candlestick. It always has to move up and down, right? It has to come and test certain levels, gets rejected at those levels, and then eventually pushes up. Now, if you don't give the market chance to retest these levels that you're ignoring, it's going to retest them, which is correct. It's supposed to do that, and then moves up in your direction, and then it has already taken you out, right? So the real reason for you to place a stop loss, it should tell you that a setup is wrong. But then if you ignore the possible things that the market might do, right, it's like someone ignoring a retest, right? You just see a breakout and then you enter a trade at the breakout. You put your stop loss right below the breakout. You're forgetting that the market always breaks out and retests. So if you ignore the retest and then the market eventually retests and then hits your stop loss, you can't really blame that on the market, right? So you have to put a stop loss at a spot that if the market gets to that level, all right, for whatever reason it uses to go to that level, it should not tap it if it's what it's supposed to do. So how do you end up actually having the best stop loss strategies? You already know that I am a price action trader. I love my price action. Most of the times I'm going to be trading, support and resistance and also trend lines, right? So all of these things, when you have a support resistance, right, you always want to place your stop loss beyond those levels, including all the areas of value that are within those zones, right? So if you have the trend line, beyond the trend line, right below all the areas of value, if you see that there are a lot of areas of value at a specific point, it's either you already know that you have to leave that trade or you're willing to take the risk. Now, if you want to have a good A+ setup, you always have to filter all of these things. So you let the trade go and wait for a better setup. Now, if you use a previous area of value to place your stop loss below it, right, you should know that if you're trending to the upside, we say we trade with the trend. If you put it below that and you're expecting the market to keep going to the upside, it means that that level should not actually be tested at all. The market should not come to that level if it's going to continue with a good upward movement, if it's going to continue forming a good trend, right? You know that if you're using a break of a support resistance level, if it breaks a resistance, it has turned it into a support, there is no reason for it to come below that previous level that it already had. If it does that, it's already changing the trend. Now, I know this is just a rough explanation with no actual practical stuff on the charts, but then if you notice, what I've just explained right now is exactly what I do in most of the videos when I am trading. You see an entry point that I have most of the time. The stop loss that I'm considering is actually below all of these levels, right? So probably in the next video, we're going to be talking in detail about all of these things, showing practical examples, showing live examples, but then I've shown them countless number of times on this channel, and I want you to actually fix that into your trading and see how great it would be to consider all of these levels and have a good, stop loss. But if you did enjoy this lazy video, make sure to hit that like button, turn your post notifications, and subscribe to the channel. You feel me? With that, it's been Tino, and I'll see you in the next lit video. Peace.